Negative 3,005 points. That's the staggering drop we just witnessed. It really leaves all of us questioning how an unexpected delay from OpenAI is dragging global indices down so aggressively today.
Hello everyone, welcome back to AI Market News. In this explainer, we'll break down this global market contagion based on available data. Today, we're looking closely at how shifting narratives in the tech sector, combined with shifting interest rate expectations, are echoing across oceans.
Section 1. U.S. Chip Sector Volatility.
As we can see in the chart, there's a clear downward momentum hitting the Nasdaq. The index is under visible pressure, shedding roughly 118 points as this chip volatility persists.
Under the hood, according to current market information, we're seeing a bit of a mixed bag. Heavyweights like Apple and Microsoft are facing significant headways and falling heavily. Yet, in that exact same sector, companies like Micron technology are posting massive double-digit gains.
So why does the broader index fall when only some stocks are down? The answer lies in index weighting. Large technology companies make up a massive percentage of the overall index value. So when these mega-cap stocks swing wildly downwards, they naturally drag the entire broader market down with them, easily outweighing the gains of smaller components.
Section 2. The ripple effect on Japanese markets.
The graph shows how this translates into a dramatic reality for the Nikkei, which plunged 4.15%. That is a devastating loss of over 3,000 points, driven by intense and unrelenting selling pressure. Now, why such a severe reaction? Japanese markets are heavily populated by semiconductor equipment makers and major tech exporters. When U.S. tech stocks experience a violent sell-off, it creates a ripple effect that forces Japanese equities to quickly follow suit as investors globally shed risk in correlated sectors.
Section 3. Treasury yields cooling down.
As we can see in the chart, the U.S. 10-year Treasury yield is actually cooling slightly, ticking down to the 4.451% level. This is a subtle but very important shift in market dynamics.
What exactly causes this yield drop? It's a classic flight to safety. When stock markets fall rapidly, investors look to protect their capital by moving it into highly secure government bonds. This surge in demand pushes bond prices up, which conversely forces their yields right down.
Section 4. USD to JPY dynamics. The graph shows a clear relationship here. As the US 10-year yield drops on the left, we see a corresponding slight dip in the USD/JPY dollar-yen to the 161.56 level on the right. The currency pair is essentially tracing the shifting sentiment we just saw in the bond market.
Why do these two move together? Because interest rate differentials dictate currency valuations. Currencies are largely driven by the difference in interest rates between two countries, meaning when U.S. yields fall, the U.S. dollar becomes slightly less attractive compared to the yen, applying downward pressure on the pair.
Section 5. Upcoming economic indicators.
Looking ahead to the economic calendar, based on available data, all eyes are on 7 a.m. ET today for the highly anticipated release of the PCE, personal consumption expenditure data, as well as updated inflation expectations. Let's clarify why this matters to all of us. The PCE is the Federal Reserve's preferred measure of inflation. This single data point directly influences whether the Fed will decide to ease or hike interest rates in the coming months, which ultimately dictates the cost of borrowing for everyone.
As we wait for these 7 a.m. ET releases, the ultimate question remains. Will a cooler PCE reading be enough to ease Fed hike odds and stabilize global markets? Or are we just at the beginning of a much deeper tech-driven correction?
Thanks for watching. Please subscribe and hit the like button.
This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.